Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. We just wrapped up our interview with Thomas Kerfoot, back office specialist. He handles a lot of the MEC, the Modified Endowment Contract issues that happen at a major mutual insurance company. Anthony, what was a takeaway or two that you had?
We talked a little bit about the MEC about a couple months ago at a high level. This one we got a little more detailed. I ain't gonna lie, I learned some things.
What?
Which means I know you learned a ton, right? And to me, I think that takeaway is that it's important that if you're want an IBC policy, you need to work with somebody who really understands IBC, who's not just going to rely on the software illustration. Because what she talks about, sometimes that doesn't always turn out to be accurate. You need somebody who fully understands the MEC line and is willing to take the time, right, to learn about it and even share about it. I mean, I think we're a little transparent here where we're asking some questions that sometimes I felt like we should have known, right? But we want to be transparent. And, one thing I say, sometimes people think that I know everything, but I don't. I don't. If you don't believe me, ask my wife, is what I always say, right? But there was some great information here. And one thing I did want to clarify is we talked about the taxation of the MEC. And I actually corrected him. And
Good say it.
Then you actually looked it up, and I needed to be corrected. So just to clarify, if a policy is a MEC, if you take money out with a loan or a surrender, the gains tax first. Okay, so
it's called LIFO, last in, first out.
Yeah, you throw in accounting terms at me. Nice. But
some people think I know everything.
Who? Okay, but tell us what was your takeaway, Cam.
Again, there's a really good conversation with Thomas. The big takeaway that I had was that, to be honest, is that MECs aren't as scary as I thought they were.
Yeah.
And one of the biggest reasons for that was, I think you shared some inside information with us that the amount of time that someone has to be able to correct a modified endowment contract, if there's ever triggered, is it's actually 14 months, not what the letter that you receive from the insurance company says, is that you got 60 days. And so that was a big part of it. And so anytime you get MEC, it's always been positioned as a very scary scenario. And so for me, that was a big takeaway, that it's not as scary, it's not as urgent, and we do have some options to remedy that.
Yeah, and he explained those, right? And we got to keep in mind we only work with mutual companies.
Yeah.
Right? They're on our side. They don't want to take advantage of or screw us. They want to help us. So if something were to happen that we didn't like, they're on our side to help us resolve it.
Yeah. Well said. Great interview. Enjoy this interview. Thomas Kerfoot, like I said, he's the back office guy, handles a lot of the MEC issues that are at one of the very large major mutual insurance companies that we use. And so hope you guys enjoy this interview.
Enjoy the episode.
Take care.
Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Thomas, man, we appreciate you coming on today. Maybe if we could start with just a little bit about your background, and then we'll kind of touch on today's topics.
Sure. Thank you for having me. My background is I work as a senior client financial services specialist in the customer service department. My jobs are kind of varied. I do some IT work. I work on policies that need system corrections. I also do a lot of accounting. From the Treasury Department, I handle probably 80 to 90 different separate accounts for reconciliations. So in addition to that, I also handle modified endowment contracts. When policies become a modified endowment contract, I usually have to deal with that and try to get that corrected for the financial professional.
Thomas, that's what we want to talk about today, is kind of some of these issues around the modified endowment contract. But before that, I would love to know what all these acronyms behind your name mean. I'm looking at your profile here, and there's quite a few. Give us just a quick overview, huh?
Okay, so most of the acronyms behind it are all LOMA related. I think it stands for Life Management something, but they're all educational. It's an educational industry type thing. So, for instance, FLMI stands for Fellowship Life Management Institute. The FSRI is Fellowship Life Retirement Institute, I think. ACS is Associate in Customer Service. ARA is Associate in Reinsurance Administration. And the AIRC is Associate in, it's like Compliance and Regulatory designation. So I have a lot of different designations, and then I have my Series 6 as well.
I wanted to bring it up just because you had more designations than Anthony. So I had to highlight that.
Which means automatically you have more than Cameron. Okay. The important acronym today is the MEC, MEC.
Mm-hmm.
Now, Thomas, you mind giving us a high level of what the heck's a MEC?
So, Modified Endowment Contract. That's what MEC stands for. And basically what a MEC means is that it's a limit that's set by the IRS. And it basically says if you exceed this limit, the IRS no longer looks at your life insurance policy as a life insurance policy. It looks at it more like an investment. And so it's going to be taxed accordingly as an investment and not as a life insurance policy. Life insurance policies get a lot of tax breaks, whereas if a policy becomes a modified endowment contract, they lose those tax breaks. So.
Now, typically, when you're talking about tax breaks, we're looking at tax-free growth and then the tax-free death benefit. So what is the impact on a modified endowment contract for these two?
So, for instance, if a policy becomes a modified endowment contract, your dividends are going to be taxable. And your death benefit is still tax-free.
Mm-hmm.
It's not the death, just basically your dividends. If you were to take a withdrawal on the policy, that would be taxable. So any withdrawals from the policy would then, be hit with taxes. So it's really during the life of the policy that you end up getting hit with taxes with the dividends and any withdrawals.
Now, Thomas, so let's say you put in round numbers, $100,000 in premiums. Okay. And your cash value, let's say, is $150,000. You take a withdrawal, let's say, of $50,000. Is all of that taxed?
Yeah, it can be. It depends, it depends on if you're a modified endowment contract, that $50,000 withdrawal, if you got a gain on the policy, yes.
Okay. It was my understanding it was first in, first out, meaning that you first take out your principal, but then anything over that as a withdrawal or a loan, that gain's going to be taxable.
Correct. Exactly. It's the gain that gets taxed.
Okay. So you put in 100, if you put in 100, take out 150, the 50,000 is going to be taxed.
Right.
Okay. Well, which I think a lot of people don't understand that. They just assume that everything is going to be taxable. So when we really look at it, look, we don't want a MEC, right? But if it happens, and sometimes there is a place to design a MEC, but it's not the end of the world.
There are certain producers who illustrate policies deliberately as MECs. It's rare. But there are certain policies who don't really mind that the policy is a modified endowment contract. So, but that's unusual. Most financial professionals try to avoid MEC wherever possible.
Sure. And, so we were talking about that there's these limits defined by the IRS. Can you explain briefly what those limits are?
Yeah, so the IRS sets a limit when you issue your policy. On any policy illustration, when you issue your policy, there is on the illustration a what they call a starting MEC limit, or an initial seven. It's called the initial 7-pay MEC limit. And the reason it's called 7-pay is because in the first 7 years, there is a limit each year that the client cannot exceed. And if they do, it becomes a modified endowment contract. That's the limit. And the limit that's set at issue goes up by a multiple of that amount every year. So for instance, if your MEC limit is at issue 50,000, in year 2, your MEC limit is 100,000. In year 3, 150,000. Year 4,
okay.
200. So it goes up by a multiple every year by whatever the initial amount is. So that, go ahead.
I was just going to ask, you gave an example of that 50,000, but how is that MEC number calculated?
A lot of things go into that calculation.
Okay.
It's face amount, its initial premium counts toward that. There's rate class, and there's a lot of things that go into that initial 7-pay MEC limit. It's not a simple calculation.
So when that MEC number is calculated, does it ever change? Mm-hmm. Right? Does that change over time, or can it change?
So that's one of the things I did want to discuss, is that normally, assuming you don't make any material changes on the policy, the MEC limit basically, just increases for the first 7 years by a multiple of that amount. So it starts out at 50,000, year 2, 100,000, so forth. And so it keeps increasing until you get to the 7th year, in which point it stops. And that amount doesn't usually change. I mean, it goes up by the multiple, but other than that, it doesn't usually change unless there is something that would cause the MEC limit to drop. And those are situations where I'm seeing policies MEC where a lot of financial professionals don't really understand that part of the equation. There's really 2 ways a policy can MEC. One is you have your MEC limit for the year, you exceed your MEC limit, and we refund the excess to get you back under the MEC limit. Pretty straightforward, and that's what most financial professionals think about when they think about MEC. They have a MEC limit, you pay more than the MEC limit, it MECs, we refund the excess, you're back under MEC. But there is a second way that a policy can MEC, and that is you do something that would cause the MEC limit to drop. And situations that cause the MEC limit to drop are usually caused by things that reduce the policy coverage. So anything that reduces policy coverage can reduce your MEC limit. Things such as putting a policy on premium offset, or taking a POA withdrawal, or exercising the non-forfeiture option of reduced paid up or extended term insurance, or doing a face reduction. Any of those things can reduce your MEC limit and cause the policy to MEC. And this can happen not just in the first 7 years, but anytime during the life of the policy. So they do have to be aware that anything that reduces coverage can, reduce your MEC limit. So my advice to anyone thinking of doing any of those things would be to illustrate in advance. Take a look, run an illustration if you're thinking of reducing coverage, and see what it does to the MEC limit. See if it MECs your policy. That'll avoid any, issues in the future.
What you mentioned a comment there, but what happens if it is a MEC? You said that really the excess is redistributed or distributed back to the policy owner. What other options are available?
Well, usually, we usually tell the client you can, the MEC letter that goes out from our company when a policy MECs usually just says, you have 2 options. You can either A, keep the policy as a MEC, or B, we refund the excess. There really is no other option because it can't stay on the policy if you don't want it to be a MEC. You've hit your limit for the year. So usually it just gets refunded to the client, and then, we're back under MEC again, and, they'll have to wait until the next policy year before they can put money into the policy again, because in the next policy year, the MEC limit goes up again. So.
Okay. Now, how do dividends affect the MEC line?
So dividends, on a whole life case, will buy like PUAs. Like if you select your dividend option is to buy PUAs, it buys coverage, and that can, it's rare, but dividends can impact the MEC limit. It's not common. I mean, they get counted toward the MEC limit as well, but it's not common that dividends would cause a significant change in what gets counted toward the MEC limit. So that dividends really, I'm not overly concerned with. It really doesn't have a large impact on it. It can impact it, but it's uncommon.
Thomas, I'm looking for feedback here. I've seen some illustrations that are designed pretty thin, that I would say, as far as kind of base premium versus PUA. And I would think that maybe a dividend change on that, from what you'd stated earlier, like a material change, could potentially affect it. Would that be accurate?
Yeah, material changes can certainly cause a MEC situation. Material changes get very complex, especially if you have a situation where you do a material change off of policy anniversary. And the reason I say that is you do a material change off policy anniversary, now you have a totally separate MEC anniversary. So your MEC anniversary and your policy anniversary are not aligned. So now it can get very confusing as to when the client needs to send in their premium to avoid a modified endowment contract. Because now you have two separate dates. You have the bills that go out that say, hey, here's the policy year in which you can send in a premium. But behind that, secretly, there's a MEC anniversary that's now not lined up with the policy anniversary that can create a situation where even if the client follows the policy anniversary and sends in the premium in the correct time, it can still MEC the policy because the MEC anniversary is not lined up. So it can be very, very confusing for especially financial producers, financial professionals that do a material change off anniversary. So any material change, I would highly recommend that the financial professional recommend that it get done on policy anniversary. Otherwise, it really makes things very complicated, both for the financial professional and for the client.
You made a comment earlier as far as having a material change after that 7-year period, or having it happen at some point later. Does that 7-year period reset, or how does that work if you do it later?
If you do a material change at any point in time, the 7-pay resets. So you have another 7 years, it starts over again. So basically all the premiums that have been paid up to that point, get shifted into a bucket that no longer count toward the 7-pay. Your 7-pay starts out at a new 7 years, at a new amount. And it's basically like you're starting over again with the 7-pay.
Have you seen, in your experience, is there a situation that typically comes up or typically initiates that maybe later in the policy that people should be aware of?
Yeah, I mean, first off, they should be aware that 7-pay does reset. That they do have attention, because a lot of times not all financial professionals are aware of that, and they think, oh, I'm done with my 7-pay, I don't have to worry about MEC anymore. And then all of a sudden they find themselves in a situation where it's MECing again and they didn't realize that it reset. So that first off is important. In regards to resetting the 7-pay, just make sure that you know what the new 7-pay amount is, so that you can. It's an easy calculation to do. Once you know what year 1 is, you can just times it by 2, 3, 4, 5, 6, and 7 to see what the limit will be in those years. So it's not hard to figure out what your MEC limit's going to be, not just this year, but for the next 7 years if you do it now. So.
No, Thomas, you were talking about that annual limit. I think you'd use 50 grand. So each year it goes up an additional 50 grand. So,
right.
But let's say in 1 year they don't pay the full 50. Maybe they only pay half of it. So are they able to pay that in the future year?
Yes, they are. They can do that. Now you've got to keep in mind that there are other limitations on the policy, not just MEC limit. I mean, if you're looking at ULs, you've got to pay attention to guideline limits, as well as if you're looking at whole life policies, you've got to look and pay attention to the annual payment limit. While yes, you're correct, you can do that. You've got to make sure that you're paying attention to other limits on the policy as well.
Great point. And I'm going to interrupt you on that. This is a great example of there's really there's kind of two entities making determinations on policy design. We have the MEC rule, but then we also, each insurance company may have their own limits and rules. So that's why it's important that we're working with a good company and a good agent who's going to know this flexibility, because life is going to happen. These clients come, I can do this no problem every year, but then stuff happens and they can't. We need that flexibility.
That's why it's so critical to illustrate. Anytime there's a change or you want to make a change, illustrate it. Just see what that will do. If a client comes in and says, "Hey, I can't afford my full premium this year. Can we reduce it?" See what that would do. If the client says, "Hey, I just came into a ton of money. Can I dump it all into my policy?" Well, maybe you can, maybe you can't. Illustrate it. See what kind of things you can do. Because we run into a lot of problems where financial professionals don't necessarily illustrate the change before they request it. And then, they're surprised when a policy MECs or whatever. And it could have been avoided had the illustration been run in advance.
Thomas, you made a comment to an option there. You called it an annual payment limit. Can you explain what that is and why it's important for someone to know?
On whole life policies with the EPP or APPUA rider, which is the PUA rider, you can have there is a limit to how much money you can put into the PUA rider every year. And that's called your PUA annual payment limit. And one of the things that I have been seeing recently as to policies that are MECing are policies that are what I consider illustrated upside down. And what I mean by upside down is that the base annual premium plus the PUA annual payment limit added together, which would be the max amount the client could put in a year, is higher than the initial 7-pay MEC limit. Okay? The problem is that the illustration does not show it as a MEC. And the reason for that is because the PUA billing amount is set much lower. So in other words, what you're telling us, that you're telling the illustration, is that this is what the client is going to pay. They're not max funding the policy. They're paying much less than what the max they could put in is. And so the illustration assumes, okay, assuming you pay that, that's great. It won't MEC. Problem is that in year 2 or year 3, our bills go out and say, okay, here's what you said you were going to pay. But by the way, you have all this extra room that you can put money in up to the annual payment limit. So the client says, oh, this is wonderful. I can put in all this extra money. And they do that, and then it MECs. And the FP comes to me and goes, I have an illustration here that says it's not going to MEC. Why did this MEC? And I have to go, well, you illustration that doesn't MEC. However, you got to pay attention because you didn't illustrate this with the client max funding this policy. You illustrated it with only partially funding the policy. So that's why your illustration doesn't show it as a MEC. And that's one of the reasons why I see a lot of MECs happen, is because, the policy's illustrated upside down, where the max that the client can put in is higher than the MEC limit.
I've seen that firsthand. And when I've seen it is when typically what we call it a kickstart, or like a dump in, where somebody puts an additional PUA in that first year, that sets the annual limit to include that additional kickstart. So they get that letter thinking they could do that kickstart every year. Insurance company will allow them to do it, but the IRS will not.
Exactly. And there's nothing on the bill that, the bills go out. They don't tell the client what their MEC limit is. They don't say, hey, you can pay up to this amount, but if you do, it's going to MEC. It just says, hey, you got all this extra room, you can put this money in. So you got to pay attention to, what your annual payment, that's why it's critical to know what your annual payment limit is, what the, MEC limit is. And, a good rule of thumb would be, if you're not illustrating the client max funding the policy, before you have the policy issued, run a max funding illustration. See, if the client chose to max fund this policy, is it going to MEC? That way you can kind of avoid this situation going forward.
You know, what I would add on there, Thomas, is when somebody gets that statement, no offense, those statements are not that easy to understand for a normal person. I don't know how many times I've had to walk it through and tell Cameron kind of how all this works. But that's why you need to be in contact with your agent to kind of help when you're making those changes. You want to make sure your agent's on board.
Absolutely. You should have the financial professional on board at all times, knowing, to help, clients understand, what the bills mean, how much money they can put in, what they've illustrated, they, said that they were going to put in. It's very important that the financial professional be involved in all aspects of that.
What's the timeline on fixing a MEC?
Yeah.
According to the IRS, the client has 60 days from the year in which the policy MECs. So basically, it's 14 months to fix a MEC, at which point it becomes a permanent modified endowment contract.
Okay. Good to know. Sometimes we have people that have a policy and we're taking that cash value and rolling it in to a new whole life policy called a 1035. How does that affect the MEC line?
It doesn't. Well, I shouldn't say that. The 1035 premium does not count toward the. However, if you're illustrating a 1035 exchange at issue, it does have the ability to increase or decrease the MEC limit. So depending on, we have situations where the policy is illustrated as a 1035 exchange, and we issue before we've received the 1035 proceeds.
Yeah.
Okay. And the 1035 proceeds come in, and they're much more than what the policy was illustrated at. Okay. And when they get applied, the system calculates the initial 7-pay MEC limit based on what was applied, not what was illustrated. So the initial 7-pay MEC limit will drop because the 1035 came in much more than what was illustrated. So we do run into situations like that. So my recommendation in any situation, especially with a 1035 exchange on a whole life policy, is hold until you have every piece of the initial premium, including any modal premium from the client, before you have the policy issued, because otherwise it can affect your MEC limit. The initial premium is kind of what sets the MEC limit, and if we don't have it all at issue, that can create a situation where it can change the MEC limit from what's on the illustration.
Thomas, so what I heard you say is that right, if 1035 money does not come over at issue, that can affect the MEC line. Is that the same thing for PUAs? Because I know that clients can pay PUAs optionally throughout the year.
Correct. The 1035 proceeds, as well as it doesn't count toward the MEC limit, and it also doesn't count toward the PUA annual payment limit. Okay. So they don't count toward either. But
let's say we don't, let's set aside 1035 for a minute. And let's say we have someone that is just paying out of pocket base premium and PUA. They're illustrated to pay maybe a monthly mode for the base premium. And then it's illustrated to receive the annual PUA in month 1, but they don't pay it until month 6. Does that have an effect on the?
Yeah, absolutely. Because the initial premium is not fully being funded. I mean, our illustrations default to assuming the full initial premium is here at issue.
Okay.
So unless you illustrate otherwise, the system is going to calculate the MEC limit based upon that, saying, okay, your full initial premium is here at issue. Now, if you do that and then you choose not to pay the full initial premium and spread the PUA out over 6, 7, 8 months, it's going to recalculate what the 7-pay MEC limit is based on whatever the initial premium that is paid in the very first month, which can be drastically different. We've had policies MEC for that reason, where what was illustrated was not what was paid. So they do have to be careful of that. If you're going to be paying your PUAs over the course of the first year, You need to illustrate it being paid over the course of the first year, because that will change your.
Okay. I'll have a follow-up question maybe off air on that one. The other one would be, speaking of timelines and that PUA along this same scenario, base monthly, PUA annually, is there any timelines that somebody needs to be aware of, right, is for paying that PUA? Can they pay it up all the way up to the very last day prior to anniversary?
On whole life, no. On a whole life policy, they have until the month anniversary before the anniversary, because PUAs are always paid forward. All premiums on a trad product are paid on the month anniversary of the policy. So whenever we receive a premium for a PUA premium, it gets future dated to the next available month anniversary. So the last date for a premium to be received and still count for a particular year is the month anniversary before the anniversary, if that makes sense.
It does. Let me explain that to Anthony. So that's month 11, Anthony, right? So month 11 is when you could pay that first year's premium. Anything after that's going to be applied to the following year.
Yes, correct.
You're welcome.
I tell you, I did know that, but I didn't know why. But now I do. So thanks, Thomas.
Mm-hmm.
One more question I've got for you, Thomas, is
Yep.
Interest on a policy, on policy loans. How is that handled? I've had questions as far as, hey, when should I pay this? How do I pay this? But if someone just defaults and sends in money kind of annually, how internally do you guys handle loan repayment interest or loan interest repayment? Loan payments.
Okay, so loan payment interest. So the client does not get to choose, at least at our company. The client does not get to choose whether or not the payment gets applied toward the base loan or the loan interest. I believe on trad products, our company says in the first 60 days after the policy anniversary, any premium that comes in for any loan payment that comes in will get paid toward the loan interest. Anything after 60 days gets just toward the loan. So they don't get to choose between one or the other. They can't pick it. It's totally based on date of when we receive the payment.
Perfect. Thank you.
I would say, to clarify, I don't know, at the end of the day, it matters, because these loans are simple interest. So if you make a payment towards principal or towards interest, at the end of the day, it's all going to be the same.
Right. Exactly. Correct.
Perfect.
Thomas, anything else that you've seen that maybe Anthony should be aware of, maybe our clients should be aware of? Anything else that comes to mind?
The only other thing that I would bring to their attention, any financial professional, is there is one situation in which we kind of touched on it before, 1035 exchanges. It is very important that, especially with 1035 exchanges in whole life, that you hold issue until we have the full initial premium, especially on cases that are on monthly billing mode. The reason is I have seen cases that have MEC'd and also hit APL simply because of the order in which the first monthly premium is paid. It matches the illustration exactly, but because of the order in which it is paid, it can actually cause a policy to become a MEC or, hit the annual payment limit. So it's really important that we receive all the money in advance before we issue that contract.
Now, Thomas, let's say that were to happen in that first 60 days. Do we have the ability to reissue that policy?
Absolutely. I mean, we can certainly do that. We can certainly back off all the premium. I mean, granted, that is not really a way we really want to go, just because now you're impacting commissions, you're impacting customer service, you're impacting your business. You're probably impacting at least 3 different departments, probably 5 or 6 or even 7 people to back everything, contact the commission department, back that all off. So yes, it can be done, absolutely. But it's a lot of work, and a lot of people get involved in that. So it's not like it can't be corrected if that happens, but it's not
Gotcha.
ideal.
Yeah, gotcha.
Thomas, thanks.
Yeah.
Yeah,
Glad
very
to be-
informative, and I appreciate you calling Cameron a professional. That I don't know if that's been on the podcast yet, so thank you, Thomas.
Episode 175 and first time. Thank you, Thomas. Appreciate it.
Yeah. Glad to be here.
All right, Thomas, thanks again for your time. Go
Okay.
make a fantastic day.
Take care.
Thanks for listening, and be sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.